one of the things that we wanted to touch on during this workshop was risk assessment and insurance. It's certainly been an increasing topic of attention, not only in the West, but other disaster-related things like hurricanes and such. And we've certainly heard about what's going on in Florida. So we're going to direct this one to Wildfire, as you might imagine. And we have with us three great speakers. Dave Jones is the director of the Climate Risk Initiative at UC Berkeley's Center for Law, Energy, and the Environment, and a senior fellow at the Climate Works Foundation. He served 2 terms as California's insurance commissioner from 2011 to 2018. He led the Department of Insurance and was responsible for regulating the largest insurance market in the United States. Dave led the department's response to California's increasingly deadly and destructive catastrophic wildfires, including the 2018 Mendocino, Carr, Woolsey, and Camp fires. In 2016, he launched the Climate Risk Carbon Initiative, which required insurers to disclose publicly their investments in coal, oil, gas, and utilities. We also have with us Janet Ruiz. Janet is based in San Francisco Bay, although we just heard where she's moving. And she was appointed as the Insurance Information Institute's Director of Strategic Communication in January 2019. Janet joined III in January 2015 as the organization's California representative, bringing with her 25 years of experience in the insurance industry. She worked for 16 years at State Farm and 9 years with Fireman's Fund Insurance Company. And then we have Joel Laucher. Joel is a preparedness advocate and independent contractor with United Policyholders, a nonprofit organization that provides useful information and resources to insurance consumers in all 50 states. Prior to United Policyholders, Joel spent more than 30 years at the California Department of Insurance, serving from 2016 to 2019 as Chief Deputy Commissioner. So that's the order we're going to hear these guys in. Adam, you can go ahead and share your screen and queue up Dave's slides. And Dave, take it away.
Great. Well, thanks for that kind introduction. It's a real treat to be on a panel with Janet and with Joel. Let's go to the next slide. So our focus is on wildfire, but I thought I would pull the lens out a little bit and talk more broadly about and try to put in context what's happening in California, but put it in a broader global context with regard to climate change and how it's driving more severe and frequent weather-related events, which in turn are causing more deaths, injuries, property damage and destruction, and insurance losses. It's very clear now, if it wasn't before, that we're going to exceed the target of trying to keep global temperatures going up no more than 2 degrees Celsius from pre-industrial levels. We might end up at 3 or 4% increase, and that's going to cause even more, sadly, changes in climate, which are going to drive more of these weather-related events that are killing people and causing injuries and causing losses. But another aspect of insurance losses and broader economic losses too is just the growth of population and businesses and the increased values that are at risk in areas that are being impacted in various ways by climate change. And you're hard pressed to find a part of the United States that isn't being impacted in some ways, although the level of acuity certainly varies. Let's go to the next slide. So I believe we're marching steadily towards an uninsurable future because we're just not acting aggressively enough and fast enough to reduce greenhouse gas emissions, which are the drivers of climate change, which are the drivers of these catastrophic weather events, which are causing insurance losses. And the way that insurers respond, and they're rational economic actors, is by raising price and or excluding particular perils from coverage, or not writing insurance or not renewing insurance, which is a perfectly rational response and a response we're seeing in various parts of the country, including California. Let's go to the next slide. So just to put it in a global context, this chart captures insured losses, not economic losses, since 1970. As you can see, the trend is up, with some variance year to year. But global insured losses, according to the Swiss Re Institute, last year were $125 billion, which is above the 10-year average of about $91 billion. So the trend is not good, and the trend is getting worse globally in terms of insured losses. Let's go to the next slide. In the United States, one way to measure this is by looking at the number of disaster events that exceed $1 billion in losses. And so this chart sort of runs from 1980 to 2023. In 2023, we had 25 events that exceeded $1 billion in terms of their cost or the loss value of that event. And as you can see, there's some variation year to year, but the trend line continues to go up, and we can anticipate that these sorts of events, whether it's drought, wildfire, flooding, convective storms, severe storms, tropical cyclones, we're only going to see more of them with greater intensity and frequency given climate change. Let's go to the next slide. So let's look at wildfire. One measure of what's happening in California in wildfire is acreage burn. So this chart captures going back to 2011 until 2021, the actual volume of acres burned. There's some variance year to year, but the trend line is going up, certainly with regard to acres burned. Let's go to the next slide. Another measure of the impact of wildfires in California is the magnitude of insured losses. So this chart goes back to 2000, stops at about, I think, 2021, or maybe 2018. So you can see, from year to year, there's some variance, but in 2017, 2018, we had enormous losses, the insurers did, with regard to wildfires. The more recent years, the losses have receded quite a bit. But again, the trend line is not good in terms of projected insured losses. And these are insured losses, by the way, just from wildfire. And these are U.S. insured losses, but California is a major driver. Let's go to the next slide. So another measure of how this is impacting the insurance industry is by looking at the combined ratio of insurance companies. What's the combined ratio? That's basically the percentage of insurance payouts and insurance company costs as a percentage of the premium they collect. So 100% means that you're paying out in terms of losses for insurance payouts and your costs of insurance. 100% means equivalent to the premium you're pulling in. So you want to be below 100%, and ideally considerably below 100% if you want to make any kind of profit in the insurance business. As you can see, that trend line was going up until about 2017. Then it rose dramatically as a result of the major wildfires in California, and then again in 2018, where the combined ratio was 241.9% in 2017 and 213.4%. That means that insurers paid out and had expenses 241% greater than the premium they were pulling in 2017 and 213% greater than the premium they were pulling in 2018. Now, 2019, 2020, 2021, 2022, better wildfire loss years. And so as a result, those costs and insurance payouts went down as a percentage of overall premium. But again, the trend line continues to go up. If you look at the 10-year average, the combined ratio exceeds that. Let's go to the next slide. But it's also important to understand, too, that in 2017 and 2018, many of those wildfires and losses caused by them were caused by utilities. And California has a very unique one-in-the-nation law that provides that if a utility causes any kind of economic property loss, you have to prove that they've been negligent. If their equipment causes it, then they are essentially subject to strict liability. And so, as it turned out, the 2017 and 2018 losses that caused those really big insurance losses were in turn largely caused by utilities, including PG&E. Well, the insurers paid out a lot of money, but they also have what's called the right of subrogation, which means they get to stand in the shoes of their policyholders and bring claims against the utilities for reimbursement for their payouts. And so this chart, which is by a consumer group, demonstrates that before subrogation, the insurance payouts were quite considerable. And this looks at just the loss ratio, which is the actual insurance payouts, not their cost of operations. But as you can see in 2017, 2018, it approaches 200%. But then after you account for subrogation, which is the insurers getting settlement funds as a result of standing in the shoes of policyholders who got insurance payouts and bringing claims against PG&E and other utilities, In fact, their losses were considerably less, arguably. Let's go to the next slide. Having said all that, I mean, there's a debate then about, to what extent is the insurance industry still profitable in California? And you can have arguments on either side of that with various data sources. But if you take a look at non-renewals and cancellations in California, the trend is not good. It's going up over time. And this chart stops, I think, at about 2021, but 2022, 2023, those cancellations and insurance-initiated non-renewals are going up. Insurers are increasingly concluding that certain homes are too risky to insure and just not renewing the insurance on a home-by-home basis because of the nature of the wildfire risk in areas where those homes are located. Let's go to the next slide. Another measure of this is by looking at the policy count for the FAIR Plan. Now, FAIR Plan is the insurer of last resort set up by the state of California to write fire insurance. It's basically an involuntary association of insurance companies writing insurance in California, and it issues a fire insurance policy for homeowners who can't get private fire insurance or homeowners insurance any longer in the market. And about 36 states have FAIR plans that cover particular risks in given states that the private sector has concluded are too risky on a home-by-home basis to cover. And so this trend is also not good. You're seeing the total number of policies written by the FAIR plan going up, and that's continued in 2022 and 2023. Let's go to the next slide. Another measure of this is the percentage of FAIR plan policies as a percentage of the total market. That's going up too. It's now about 4%. This chart stops at, I think, 2021. But that's an indicator too that things are not going well in the insurance market because more homeowners are being forced out of private insurance and into taking a FAIR plan policy. FAIR plan policies are expensive because by law they have to be risk adjusted, written based on the actual risk. And so the more people thrown into the FAIR plan, it's one indicator that the private insurance market is having a challenge or is challenged in writing and renewing insurance in California, parts of California where there's a high wildfire risk. Let's go to the next slide. So more recently, a number of the top insurance writers in California have announced that they're going to pause or restrict new insurance writing. So the top 12 companies make about 85% of the state homeowners market in California. 7 of the 12 have said they're going to stop or otherwise restrict writing new business. And this is after getting rate increases from the Department of Insurance in 2020, 2021, 2022, and even 2023. So that is a challenge. Let's go to the next slide. What the Department of Insurance and the Insurance Commissioner have announced they're going to do about this is something called an insurance sustainability strategy. Without going into too much detail, I want to focus on bullet 1 and bullet 2. I'm sorry, bullet 3. Bullet 3, as a part of this proposed response by the Department of Insurance, would be to allow insurers in California for the first time to use forward-looking probabilistic models in setting price. That's something the insurers have wanted for a long time. They'd like to use these models. There's arguments that have been made by consumer groups and department staff with regard to the black box nature of the models, the potential for proxy discrimination. Are the models actually warranted? But the commissioner has decided to open the door by initiating a rulemaking that would allow these models to be used by insurers in setting price. However, this would be in exchange for what's in bullet 1, which is the insurer using those models would have to agree that they would write no less than 85% of their what's commensurate with their statewide market share in high-risk areas. So this is basically a deal that the commissioner is offering, which is to allow these models to be used, which may very well result in higher rates in exchange for carriers committing to at least writing commensurate to 85% of the statewide market share in high-risk fires. The idea being that it will hopefully result in more insurance being written as a result of their being allowed to use the models. Another aspect of this proposal, too, is to allow insurers to incorporate reinsurance costs in their rating, something that California doesn't currently allow. Let's go to the next slide. But Florida. Let's go to the next slide. So Florida has also had a very, very challenged insurance market. This is a chart by NOAA. Each colored line is for a particular year, and this represents the cost of billion-dollar disaster events in Florida. And the kind of orangish line at the very top is $112 billion in losses in 2022, largely driven by Ian. Each of these colored lines represents a different year. It's not entirely linear, it bounces around a bit. But again, the trend is up over time with regard to losses in Florida as a result of wind events, cyclones, and hurricanes. Let's go to the next slide. That's been a big challenge for the insurance market in California. And what that has meant is that a number of insurers in California have stopped writing, have left the market entirely. and they have pushed more people in Florida to Florida's version of the FAIR plan, which is called Florida Citizens. And as you can see over time, the number of policyholders has gone up dramatically in Florida just between June of 2020 and the end point of this chart. And now we're at about 1.3 million policyholders in the insurer of last resort in Florida. And the reason that's happening is that private insurers in Florida have decided that they just can't afford to write home insurance and cover wind losses associated with these big storms and hurricanes. And so they're exiting the market, and that's pushing more people into the Florida insurer of last resort. Let's go to the next slide. Now, Florida has done a bunch of policy responses, including allowing probabilistic forward-looking models, allowing reinsurance costs to be included. They've eliminated assignment of benefits. They've eliminated one-way attorney fees. They created a public option, a public reinsurance facility. Reinsurance is insurance for insurers. And Florida Citizens, which is the insurer of last resort, can actually assess all Florida policyholders if there's a reserve shortfall, something the California FAIR Plan can't do currently. The rates are 3 times the national average. There's a program to try to depopulate the Florida Citizens program. So all these different policy changes, some of which are very consistent with what the California Commissioner is proposing. Let's go to the next slide. And while those policy changes have resulted in some recent benefit, you can see in that last quarter there for 2022, there's finally been a little bit of positive net income for Florida residential insurers. But really the jury is still out whether or not these policy changes are going to be sufficient to allow private insurers to make money and to keep writing insurance in Florida. And I think Florida may be an illustration of a kind of peril that's driven by climate change, and that is hurricanes and wind losses, where we may be fast approaching a state of uninsurability because the risk is too high and the potential loss is too high, and it's simply not possible for insurers to make a go of it. Let's go to the next slide. So again, some very recent improvement in Florida market, but again, the insurer of last resort is still insuring 1.3 policyholders. I mean, even since these policy changes were announced, Farmers and 5 other insurers are saying they're pulling out of Florida entirely. 15 companies overall stopped writing new insurance over the last couple of years, 7 companies insolvent, 18 companies on the Department of Insurance watch list. So things are really challenged in Florida. The jury remains out on whether the policy changes that have been announced are going to be sufficient to overcome what's happening vis-a-vis climate change-driven hurricanes and the associated losses. Let's go to the next slide. So how do we stop the march towards an uninsurable future in California? Well, one is we got to act faster to reduce greenhouse gas emissions. We got to stop putting more people and businesses in harm's way. We need to improve and enforce building codes, and some great work has been done in that regard. And also look at land use requirements that mitigate risk, things like home hardening, defensible space. I know that Jan and Joel are going to talk about that. But then there's also the possibility to invest in nature-based mitigation, and that is investing in nature-based approaches that reduce risk. I'm going to talk in a moment a little bit about one of those in more detail. Let's go to the next slide. Give the FAIR Plan the authority to issue bonds to cover its losses, amend the catastrophe factor and rate regulation to account for statewide catastrophic losses. But here's another one. Right now, insurers are actually investing $569 billion in fossil fuels, and it's the fossil fuel industry that's the main producer of the greenhouse gas emissions, which in turn are driving climate change, which are driving significant insurance losses. So it really doesn't make sense for insurers to keep insuring fossil fuel enterprises and to invest in these enterprises, because it's these very enterprises which are causing the climate change that's causing it a challenge for insurers to keep writing insurance. So they ought to stop doing both those things. Another is it would be really, really good if the underwriting models used by insurers actually account for forest scale treatment. I'm going to talk a little bit more about that in some detail, and home hardening. I know that Janet and Joel are going to talk a little bit about the extent to which the rating models account for home hardening, but the underwriting models, very few of them actually account for that. Let's go to the next slide. So I just want to do a deep dive in the minute remaining to me. There's a tremendous wealth of empirical evidence that forest management reduces wildfire risk. And this is managing forests the way that nature managed forests before 120 years of absolute fire suppression in our western forests. This is using things like thinning and prescribed fire to clear out what are called ladder fuels, the smaller trees and all the vegetation that have choked our forests because we haven't allowed fire to naturally occur. And so it does actually reduce the risk of severe wildfire. Let's go to the next slide. The problem is that the insurance underwriting models, the models that they use to decide whether to write insurance, while they may to some extent account for home hardening, they may to some extent, although not all of them do, account for community mitigation, they don't account for landscape scale forest treatment. Here we're talking about actual treatment in the national forest or other forest lands. About 60% of the forests in California are owned by U.S. Forest Service. The state of California has appropriated $2.7 billion for forest treatment. In the infrastructure bill, there was $5 billion appropriated nationwide for more treatment of federal lands from a forest mitigation standpoint. Or a natural lands fire mitigation standpoint. A big chunk of that will come into California. And yet the underwriting models and even the rating models, by and large, don't account for the risk reduction benefit of these landscape scale assessments, treatments. Let's go to the next slide. So, this again ticks through some of the investments that are occurring and are going to occur in forest treatment, and we're going to see more of this over time. Let's go to the next slide. But I think one solution in terms of trying to provide a path for insurers to continue to stay in places like California that are challenged by wildfire risk growing due to climate change is that the models they use to decide whether to write or renew insurance and the rating models ought to include the risk reduction benefits of forest management. Final slide. So I'll stop there. That was kind of the rocket docket, but excited to hear from Janet and Joel and looking forward to the conversation.
Yeah, thanks, Dave. I think you got everyone's attention based on the comments in the chat. So go ahead, Janet.
Thank you. And you can bring up the slideshow, Adam. I'll just start by introducing who the Insurance Information Institute is. I've been with them since 2015. Next slide. And we're a trusted source of unique data-driven insights on insurance. I know that sounds exciting. We're a nonprofit insurance trade association, and we are supported by insurance companies. And our mission is to inform and empower industry stakeholders, journalists, media, legislators, and consumers. One difference between us and most insurance trade associations is we don't lobby. So while we will testify at hearings, we are a non-lobbying organization, which gives us a little bit of a different way to connect with the public and be a credible source of data, etc., and insights on insurance. Next slide. So I'm going to start just by talking about why are insurance rates rising, because that is a big topic on the minds of the public, especially homeowners, business owners. And, it's the three basics: inflation, building costs, climate risk. This is nationally. And then we're going to focus on wildfire today. So while we do have wildfire in many states, we have seen the most wildfire losses in the insurance industry in California in recent years. So replacement costs have skyrocketed during the pandemic, Russia's invasion of Ukraine. Rebuilding costs actually outpaced inflation. Wildfires and construction trends in the wildland-urban interface that we like to call the WUI put increased amounts of expensive property at risk. And that's especially in California. We have a lot of expensive property across the state. According to CAL FIRE, which is the fire service that really addresses a lot of the WUI areas, 5 of the largest wildfire in the state's history have occurred since 2017. And Dave showed you so much great data and information. So my slides are a little more basic just to talk about the actual insurance industry perspective on the effects of all these things that Dave and I and Joel will talk about. Next slide. So Dave also hit on this, and I want to let you know right up front, the insurance industry really wants to write insurance in California and stay in California. Dave mentioned it's the largest insurance market in the US. I believe it's a fourth of the total insurance market. So we want to be here. We want to serve our customers. We all own homes and businesses and live in this state as well. So I'm going to just re-emphasize what Dave said. He had the chart that showed you the combined ratio. And that's how profitability is measured using the combined ratio. It represents the difference between the claims and the expenses that insurers pay out and the premiums they collect. So basically, you collect the premiums, you pay out the claims and expenses. As he stated, a ratio below 100 represents a profit, and one above 100 represents a loss. So the claims and expenses paid in 2017 and 18 due to those large wildfires that we had were so extreme that the average combined ratio for the last 10 years ended up to be a 108.1. So for every dollar that we took in, we paid out $1.08. So that's no profit. That's a loss for 10 years. Next slide. So I'm just going to go straight to how will we return to a healthy insurance market. And I do want to provide the sentiment that the insurance industry, the insurance companies, the agents, all of us that work in it, we are expecting to get back to a healthy insurance market. One of the ways we're doing is working with the California Department of Insurance on this sustainability plan. Dave also pointed out we're using risk-based models in the rate-making process. And I thought one good point, Dave, that you made is the importance of using more than the actual homes and businesses, structures, home hardening, community efforts, etc., but also using all the efforts that are being made. And we have a really interesting program put together by Nancy Watkins from Milliman, which is an actuarial company, and two former fire services folks who now work at San Luis Obispo, and Dave Whitaker, who is the fire chief for Bay Area, Moraga, Orinda area, which is a wildfire prone area. And their program is all about wildfire pathways into communities. And that will start taking into consideration many of the things that Dave was talking about with forestry health. We're also seeing companies like, and I usually don't mention companies, but names, but I will say CSAA, who's based in Walnut Creek, right near San Francisco. They are doing investing in forest projects. And I think we're seeing more and more of that as we all work together on this. We want to include the cost of reinsurance in our rate making process and improve the turnaround time of our rate filings. All these things have kept insurance premiums low in the state of California. If we look back at 2018, the average cost of an insurance policy across the state was $1,200–1,300, whereas in other states like Louisiana, it was over $2,000. A little more expensive to build in California. So we're looking, and as Dave said, it's starting to happen now with the sustainability plan. We're seeing the actual admitted insurance carriers starting to be able to charge appropriate premiums so that we don't take in $1 and pay out $1.08. And then I think one of the most important things we need to do is support wildfire mitigation, home hardening, defensible space. and community resilience overall. This is happening. One of the changes that we've made at the Insurance Information Institute and with our parent company, the institutes who do a lot of insurance education throughout the country, is moving to a predict and prevent wildfire risk model. We used to always be more prepare and recover. So now we really are looking more at how can we predict the risks in any part of the country, but we're talking wildfire, and prevent them from happening. And this will help communities to be more resilient, and then also working with many stakeholders. So I would say in my long career of insurance, when I look back, 20, 25, 30 years, we did have some work with stakeholders. I did work a little bit with the University of Berkeley, where Dave actually does a lot of work now with their natural resources group, but it was minimal. And in the last 10 years, I've seen all of us at the table, at conferences, at hearings with the legislators, etc. So we're all talking because insurance is the financial response, but we see communities being devastated, and it takes years to get them back on track when they've had a big wildfire come through. Businesses have burned, resources. Often we see pollution in the water. The land clearing is incredibly expensive now because, there's a lot of environmental concerns. So we see predicting and preventing and, really funding and supporting the research that's being done, the prescribed burns that are being done, all the work that is being done as extremely important. And insurance companies and the industry are on board with providing that. We also are looking at different ways to fund insurance gaps. And I don't have time to go into detail on those right now, but there are alternative risk transfer programs, there's catastrophe bonds, etc., that will help in the national market in being able to have more complete insurance in some of these gaps. A couple interesting things that are happening are in the state of Alabama. They have funded so many grants for new roofs. And that is one of the big issues in Alabama is the wind and the roofs, that their insurance market is actually more stable than, say, one in, the market in Florida. And Florida is what we're trying to avoid. While, we've looked at a lot of the issues that Florida has, one of the things we didn't talk about was the extreme legal abuse and nuclear verdicts in Florida. They are trying to curb them, but there's another issue, third-party funding of litigation that really has also contributed to the issues that they're having in Florida. So while we have some similarities, we believe that we can keep California from going the same road as Florida. And that's why we're all working together and working so hard to, keep that, keep out of that type of situation that Florida's gotten into. So next slide. I just want to end my little part of the presentation talking about the importance of mitigation. The Institute for Business and Home Safety did extensive science-based mitigation work to find out what burns, what doesn't, how do embers travel, and we've put together, or they've put together, and we support this program called Wildfire Prepared Home. Folks can do the mitigation work, home hardening, land clearing, and get an inspection and a certification that they are a wildfire prepared home. This is really helpful, and it was launched last year, 2022. So it's still getting traction, but it will make a difference with insurance companies and insurability. And then community action is key. So FireWise USA, Fire Safe Councils in California, fire adapted communities in many states are really making a difference. And, you know, Dave and I talked earlier, we both live in wildfire risk areas. Homeowners associations that, you know, get involved with FireWise USA, Fire Safe Councils can really make a difference and move the needle towards more insurability, less losses, and really community resilience. So I'm going to stop there. I know we're going to hear from Joel and then have time for Q&A. Thank you.
Thanks, Janet. All right, so Joel wanted to go last so he could take pot shots at Dave and Janet. That's what he said. And now the slides are ready, so Joel, go right ahead, and then we'll follow up with some Q&A.
Okay, well, thanks to everyone who's here and still listening. Wasn't long ago, we'd never expect anyone to voluntarily attend a presentation about insurance. Maybe you're being forced to sit in today. I don't know, but I hope not. Next slide, please. So I now work for United Policyholders after I started in this business as an underwriter for 5 years and then was 35 years with the Department of Insurance. But towards the end of my career there, I was being sent out to a lot of post-wildfire events. And often we would do events, department would combine with United Policyholders because they were so great at helping people work through the claims process, which is a very daunting process. Just one comment on that in terms of how the impacts of a wildfire. I was noticing in the paper in Santa Cruz, the CZU fires that happened just over 2-3 years ago. 2 years after the fire, had passed and had consumed 911 homes, 2 years later, only 11 of those homes had been rebuilt. It takes much longer to rebuild after a fire than people even anticipate at all. But so they really are life-changing events in so many ways. Next slide, please. So after all this work helping people with claims issues, these very same communities that United Policyholders has been working in are the same ones, of course, now that are having issues obtaining coverage. And so United Policyholders has started an initiative to focus people's efforts on mitigation and also on an effort to help people find insurance in a very challenging market. Next slide, please. So not every home has trouble getting fire coverage in California, just so you know. There are certain steps you can do, just like this home. Next slide, please. Or this one. And I do want to note that that is a non-combustible drawbridge. So that's an important feature too. So if you build homes like these, you're likely to still be able to obtain coverage. Next slide, please. But, Dave and Janet already have shown some charts. I know you're journalists, so I wanted to share some of the places, you might want to look for information. This one is on the CDI website. It's the market share reports. And I'm going to give you a little more close-up of this so you can actually read it. but it gives, so next slide, please. That top part really shows for California, the year-by-year written premium for homeowners insurance in California and the incurred losses. And you can see the first year listed there was 1991. I think that might have been Oakland fire or the tunnel fire. And then you get down to the very end, 2022, you can see we're at about a 55% loss ratio. Just a couple of years up the ladder there, you see those 201% and 170% in that last column down there for 2017 and 18 for the wildfire losses that, kind of started this story on its downward track. Next slide, please. Also interesting on that very same informational page is some numbers that kind of fill in more of the story. And you can see in California, homeowners insurance premiums have been steadily on the rise. Sometimes they take a little bump. And of course, because of those recent catastrophe losses, the arc of premiums has gotten a little more steep as rate filings come in. In California, we have prior approval process for any rate increase or decrease. And currently there are, there are dozens of filings currently pending for homeowners insurance to initiate more rate increases, but you can see premiums are steadily increasing. Meanwhile, chart right next to it on top, the company count has gone down. And a lot of this change over the years has been mergers and acquisitions, not companies driven out of the state due to loss ratios, but a lot of companies swallowing each other up, seeking to gain more market share, companies going out of business in California because they can't compete. So what this has done, of course, the smaller the number of companies, the more concentration of risk you get. So all of those acquisitions and mergers really ultimately have a detrimental impact when companies stop writing to increase their coverage amount. You also see the incurred losses and loss ratios, of course, that follow kind of the same arc of how much premium is being paid out each year in California. Again, this is from the Department of Insurance website. Next page, please. Another interesting thing to follow up on that concentration of risk. This is from an entity that puts out the Property Insurance Report. It's another source of information about insurance in general. Property insurance, of course, includes homeowners insurance, commercial insurance. And this one was interesting to me, at least, because it showed, a lot of the companies that aren't around anymore in California. When I started out back in 1980, I worked for a company called Commercial Union Insurance Company. They're on this chart. They were bought out. I examined companies such as Unigard and Fireman's Fund and Continental Insurance when I became an examiner with the Department of Insurance. Those companies are all gone, all bought out. And of course, there are more and more concentration as their business is absorbed by other larger carriers. Next slide, please. And this is just some of the detail of some of those same companies I just mentioned. And you can see it gives the details of who they were sold to or who they merged with. Next slide, please. So now I want to tell you a little bit about how rate increases work in California. I mentioned they have to be approved by the Department of Insurance. We also have a process in California where an intervener can come into the process. Basically, an insurance consumer group can enter into the evaluation of whether an insurer's rate request is reasonable. And if they make an impact on that final decision of by the department of whether the increase is justified or not, they get compensated for it. So it's just one of the different kind of components of how California works. But so that occurs, there's an obligation to go to hearing if an insurer asks for an increase over 7% and an intervener enters in and asks to object to the increase. It would have to go to hearing. So consequently, most filings come in at 6.9%, just under that threshold. So consumer groups can still intervene, but there's no obligation that the matter goes to hearing. But this chart, interestingly enough, is how a 6.9% rate increase can play out. And what it is, the distribution here that you see, we have 3 bars and we have these 5 categories. So this was a 6.9% rate increase overall to the insurer's entire book of business. And they use at this insurer risk scores based on a model that projects the degree of risk that any one home is subject to. And it scales homes from 0 to 100. So 0 means you have no wildfire risk. 100 means you have the highest possible wildfire risk. So we see these bars are kind of broken into those different score categories. So at the lower end of that scale, 0 to 59, the blue bar represents the homeowners at that level today, at the rate level today, and it shows they're paying about $1,000 on average per home. So for all these folks that this company writes, all the homeowners at the lower end of the wildfire scale, they're paying about $1,000 average. And the green bar is what the insurer making this filing is asking to increase their rates to. And if you could read that specifically, it looks like their premium, they want to increase their premiums by maybe about $25 or $50 on average. There's hardly any increase at all that's going to happen for that group of homeowners. The gold bar is actually what the insurer says they could ask for, that they could justify, but because they're only coming in at 6.9%, they're not asking to go to the full extent of what they could ask for. So as we move to the right along this chart, you can see the next scoring group, 60 to 69. They already pay a little more, maybe about $1,500. Looks like they're projected to pay about $1,900 based on the green bar. And if the insurer had its way, it would be charging them about $2,200. So a more significant increase. But as you move across, of course, let's just go all the way over to the right. You see the highest risk scores, 90 to 100. You can see that people in that category, whose homes score in that category, are currently paying about $1,500. If this filing is approved, which it ultimately was, those same homeowners' premiums would increase to $3,500. So more than double. And the insurer is actually saying their premiums should increase to about $6,100. So you have an idea of what the insurer's next filing will look like for the same group of homeowners. So the point here is that even when an insurer asked for a 6.9% increase, it doesn't play out as 6.9 across their whole population of insureds. And that probably very small population there at 90 to 100 may only represent a couple of percentage points of the insurer's policyholder population. So they're basically able to significantly increase those premiums, even though they're only getting a 6.9% increase overall. Next slide, please. And the other, what are the drivers of those risk scoring processes? Well, there were a couple major risk models in place initially, probably about 12 years ago when this became an item in insurers' rating plans. And they basically measured only three things of significance: the slope, the fuel, and the access of each home. So the home being evaluated would be at the center of one of these little targets, the green circle or the red circle in this picture here. This happens to be Santa Cruz, California vicinity, if you're familiar with that, on the Pacific coast. So the green circle, that's the lower risk home here. It's a lower risk home because it is down below the mountains that you can kind of see the ridge lines there up above. It's in a relatively flat area. There's relatively low fuel because it's in an urban area, and high levels of access. The fire department can get there readily. The one home up in that red circle, and again, you can't see the home itself or any detail about the home because this kind of imagery that was being used can't get that level of net magnification. Well, that home is just going to be based on the its evaluation based on, the slope of the hillside it's on, how much forest or brush is in the vicinity of the home. And for this home, no doubt, how inaccessible it likely is, possibly, only one road in and out, and thus could have a high score. Thinking back to the chart we just were looking at, this would be one of those homes whose premium is going to rise with that insurer, likely from somewhere around 1,500 to somewhere with it around 7,500 within a couple of years' time. And given that chart's a few years old, this home probably today has a hard time even finding coverage. But these are the older evaluation processes that insurers use. Next slide, please. Today, we've moved from satellite imagery to aerial imagery, and many more home-specific or structure-specific data points are flowing into the scores that insurers are using. For example, using today's aerial imagery, these scoring companies are able to evaluate the type of roof that the home has. It can determine if there is a clearance around the home to help protect it from bringing the fuel to the home itself. And other data points about the home are also fed into the model. It knows the year built, so it will know what were the building codes in place at the time. For example, it will know that you have ember-resistant vents built into the home if it was built after a certain date in time. And for insurers that use these models, one thing for everybody to know, if you do change out your vents, you need to tell your insurers. Of course, you need to do that now to get the discounts now made available in the California department. So again, the science is evolving quickly. The data points are becoming much more granular, much more specific to the home. And so the actions you do to mitigate your home and reduce your risk are having a much bigger impact on your wildfire risk score. So that's good news. Next slide, please. So, despite all that, these new models and people taking all these efforts to improve to mitigate their risk and improve their home's chance of survival, we are having a challenging market in California. So why is that? Well, Dave and Janet both mentioned climate change. Of course, this is impacting everywhere in the world. And, Dave mentioned some of the major measures that need to take place if we're going to do something about that. Concentration of risk. Now, there was some mention, Janet mentioned too, that, inflation has brought up the values of homes. And that is true. That has happened, particularly in California. But, to some degree, insurers, as I mentioned, brought this on themselves. Our market has consolidated and we've lost quite a few insurers. And so it's pretty tough when the insurers, that look to expand all of a sudden decide they don't want to write any more risk and even non-renew some of the risks they have. It's, somewhat understandable given the circumstances, but also, this concentration was somewhat predictable. It's going to take an active market. And of course, the only way you really get an active market is to lower the risk profile. So again, we're going back to the mitigation side of things. In California, we do have catastrophe model restrictions. Can't use models that project future loss, and we don't allow cost of reinsurance to flow into the rates. Now, the current sustainability plan proposed by Commissioner Lara would undo both of those restrictions, and no doubt that would make the insurance industry happier about the rate levels they would get. But I think, as you noted in Dave's presentation, Florida already allows these things, and that hasn't saved their market. And if you think back to the chart I showed you of those rate increases and who is going to get the highest rate increases, well, of course, that will mean more cost will flow to those homes at the higher risk, who are already paying double and triple and quadruple of what they paid just a few years ago. So I think we found that insurers have already found a way to significantly charge premium to those at the highest risk. There are improvements certainly that can be made to the California rating formula. So I'm not saying there isn't a need to make some changes there, but I think we need to be more cautious, and these two changes would really throw the door open to unlimited rate increases, essentially. Next slide, please.
Hey, Joel.
Yes.
It's Dave. I don't mean to speed you up here, but I want to make sure we've got time for questions.
Okay. I'll end in 1 minute.
Okay. You are the man. Thank you.
Okay. This just again to point out that there's a lot of information in the California Department of Insurance website, including top 10 tips for shopping for insurance, and insurers offering discounts for those mitigation actions, and an insurance finder tool. Even with all those top 10 tips, super hard market if you're in a wildfire related area. You got to admit. Next slide, please. And of course, the CDI has rolled out a list of mandatory discounts that every insurer has to offer. If you've done any of these things, report it to your insurer. They're on the next couple slides as well. So next slide, please. Same clearing of vegetation, non-combustible materials, Class A roof and closed eaves, a whole list of things where insurers are mandated to give discounts. Next slide, please. And we have a lot of information available to you to help you with who can do the work, what work needs to be done at the United Policyholders website. Next slide, please. The UP website also has resources on a county by county basis. A lot of local agencies helping out with mitigating risk and grants and other benefits from your local fire departments and governments. Next slide, please. Listos, another California resource for finding how to be fire ready. Next slide, please. And again, United Policyholders, here to help in any way we can. And that concludes my presentation as well.
All right. Thanks, Joel. I appreciate that. And thank you all. Really important and alarming stuff. So journalists, if you could turn your cameras back on and let's talk about this stuff. Sarah had the first question.
Yeah, thank you. I'm currently in Argentina on a Fulbright grant studying wildfire mitigation, but I used to cover housing in San Francisco. And my question is about rental insurance. I'm just curious. I know a lot of people are renters. A lot of people in high fire risk zones are renters. How are there advisories that renters are supposed to be receiving from whoever they're renting from? Or where can they go to find more information about their risk and then their potential for coverage, and what's kind of going on right now in the rental insurance space as it pertains to fires?
Renters are mostly insuring their contents and their liability. So it's less of an issue with renters than it is with homeowners. The only people that aren't selling new policies to renters would be like State Farm, Allstate, and a couple other smaller companies. So most of the other companies, and there are over 100 insurers in the state still writing, even though, Joel did mention consolidations. I worked for Fireman's Fund, now they're part of Chubb. But other than the insurance companies that stopped writing new policies, I think renters still are able to get policies in most areas. They may struggle a little more in the very, very highest risks, but I haven't heard issues in the Bay Area that you're referring to with renters. And we do really promote renters because it is still very low cost. And very useful, if you get misplaced for anything. Last year in California, we had extensive winter storms. So, we always encourage renters to pursue renters insurance.
Yeah, I'd actually add to that last comment, Dan, it's because I get sent to local assistance centers and disaster assistance centers on behalf of United Policyholders. And while it's a challenge to go through a homeowner's claim, the main issue that comes up with renters is they don't have any coverage. They haven't purchased insurance. So I wish word would get out more to convince people who are renting of the value of insurance, because when something happens, they're out of their rental that day, right? It's the fires occurred or the flooding, as Jen just mentioned. We had down in Santa Cruz flooding and windstorm, and people had nothing. They have to find a place that night, and they have nowhere to go and no money, to pay for it. And it will likely be several weeks before you can find another rental, especially in challenging rental markets. It's unfortunately the least purchased, I think, coverage for the number of people that should have it.
We are seeing with the higher rental, it's way more expensive to rent a place than even when my kids were getting out of college. We are seeing more landlords require rental insurance, and that's a great thing, because then, they are required to buy it and it's good for them. So, I think we're seeing an uptake in renters insurance, but again, having landlords required is very helpful.
All right, Alex Hargrave.
Thank you all for all of that information. I'm from northeastern Wyoming here, and when it comes to fire risk to homes, I'm thinking a lot about the national forest that is nearby, and it's an interesting situation there because there's a bunch of cabins on national forest lands. There's the National Forest Homeowners Association. They own the home that's on the land, but they're leasing the land from the Forest Service. So I'm curious how insurance companies handle these situations, if it is a unique situation, or if it's just handled like any other home. I'm just curious how that works.
So let me just big picture make a point that I made in my presentation, which is that while it is the case, each of us have referred to the fact that the California Department of Insurance has issued a regulation that requires insurers to offer a discount for homeowners to do home hardening and do defensible space around their home and are in fire-wise communities. It is currently not the case that there's any discount or even consideration in underwriting, which is the decision whether to write the insurance or renew the insurance for a home, as to landscape scale forest treatment. And vast parts of Wyoming are in forested or other lands that are at high risk of wildfire. In California, 60% of our forests are national forests. A large part of our topography is forest lands. And even though the state of California and the federal government and local governments and homeowners associations are investing a lot into landscape scale forest treatment, there's no mechanism for a discount. And even if you got the discount, that doesn't mean that you're going to get the insurance written, right? And so that's a big omission right now. And in a paper that I authored while I was at the Nature Conservancy with Willis Towers Watson in 2021, we showed that it's technically feasible for insurance risk score models to account for forest treatment. Those results were replicated independently by Moody's RMS, which is a big cat modeler. So it can be done. It's just the case that currently the direct writers of home insurance in California, and I think this is true across the United States, are not accounting for forest scale forest treatment. And that really needs to change. And so it hasn't happened on a voluntary basis. So, maybe necessary that the laws be changed to require that to be accounted for. But it's a big omission. I can't speak to leaseholds in national forests. I mean, I would imagine you can, putting aside from all of the issues the insurers are having with the surrounding risk associated with wildfire in that forest, I don't think there's an impediment necessarily to getting insurance for a long-term leasehold interest in a national forest, but I'll defer to Janet on that.
I'm not as familiar with the insurance regulations in the state of Wyoming, but you would have to be listed as responsible for the home. So usually, you're the homeowner, but we see it in like manufactured homes. You don't own the land, but you do own the building. And so, insurers do offer insurance to manufactured homeowners. So I expect that they have a similar type program with the leased land, as long as the person owns the actual structure. And I'm glad that you mentioned Moody's RMS. One of my close friends ended up moving from the insurance industry over to Moody's RMS, and they are doing really good work And I think there's a lot of the risk modeling and technology companies, especially here in California, we're kind of the heart of, Silicon Valley. A lot of progressive work is happening, and the industry is really depending on that. And issues like Dave is bringing up to move forward. We look back at history when we look at, we paid out $1.08 for every dollar for the last 10 years. However, we want to look forward to what's coming and move forward. Insurance is pretty resilient and always looking at new risks. I remember, studying when the first automobile policy was written. It used to be at Fireman's Fund. They wrote the first insurance for automobiles, but it was based on boiler and machinery from ships. So we've seen, really in relatively a short amount of time, the auto industry be, completely changed. And now I do a lot of discussions with the media on electric vehicles, autonomous vehicles. How are we insuring those? So we do try to move forward. And this is an important time in history.
The one thing I think, just to add on this part of our discussions, there are two types of kind of wildfire risk models that we are talking about. One, like my slide showing in Santa Cruz, that gives you a risk score, and that's based on components of risk around your property. And I think it's a large part of what Dave's referring to here in terms of wanting more granularity so that it identifies, not just the slope, but whether there's a shaded fuel break in the area and, things more about your home, which these models are starting to include in their evaluations. And so those evaluations go into whether you're eligible for coverage and what rate you pay in terms of differentiating a home that's mitigated or at higher risk from another. But there's another kind of wildfire model that projects the insurer's predicted losses based on the whole book of business that the insurer writes, right? And that's a different kind of model, projecting loss data that would then feed into the insurer's rates that determine the rate. So two separate types of models. The one that scores homes and is used for eligibility and kind of deciding how much of, rate variations, but not how much the total rate is one kind of wildfire risk model. And the other is the predictive model, projecting what the insurer's losses will be. And those go into the rate making.
Great, thanks. Murphy has a question.
Actually, go ahead and go on to Alexandra.
Okay, Alex Wigglesworth.
Thanks. So just coming at this as like complete outsider, because I haven't written about it, it seems like a challenging issue to cover because there are business interests involved. And like in California, it's not clear to me like how much of the insurer pullback has been because the companies are suffering a loss of profitability, which is what like the companies would say, and how much of it has been kind of political posturing to pressure the state to roll back some of the regulations that insurers don't like, which is what some consumer groups say. Like, how do you suggest reporters navigate this?
Well,
Talk to both.
Yeah, talk to both. And I think I was just reading the opinion piece from the Southern California News Group that really, says California is in the throes of an insurance crisis. But talks about government regulation as well as some consumer groups that aren't actually represented on this call, really have targeted some of the wrong things and tried to keep insurance rates artificially low. there's a balance to all of it. And again, you know, why would insurance companies not want to write in California? They do want to write in California. It's a fourth of, you know, the country's market. So we are working on, you know, many solutions. I think the interesting one is the wildfire pathways. And I think, Dave, you probably have talked with Nancy and her team, Nancy Watkins, on things like that, that will really dramatically change how we look at fires coming into communities, how we keep, you know, them out of communities, keep communities from burning. We don't want to see another campfire like the Paradise one or the Woolsey fire. Those, you know, those are really unfortunate. So there's a lot of work being done. There's also some, you know, I mentioned Moody's RMS, Dave mentioned them as well. But there's Zesty AI is another group that's doing a lot of good tech work. There's also a small insurance company called Delos, DELOS, that actually has a couple of younger folks from the aeronautics industry that are doing amazing tech work, all that will help us better insure. And then there's all the work being done on scientific-based mitigation in the forest, you know, around the homes, in the communities. I mean, for me, those are the hopes of moving forward as a consumer as well as an insurance industry professional.
Yeah, my question had been to your question, Alexandra, is I'm not sure why insurers shut off urban business as well as their more at-risk business if their concerns were about the reinsurance costs that are arising due to those catastrophic losses. Insurers have been able to get enough rate for urban business. And presumably a lot of that business, there's still a lot of business to write that isn't wildfire exposed. So a total shutdown, just to my opinion, I'm, you know, just an old guy now, but seems to be trying to make a statement. You know, I just don't feel it was necessary to lock down the entire market.
And we often agree to disagree on these kind of discussions, which is why it's good to have, you know, the views of all of us. But one thing that you know, we saw with, we can name the names because it's public information, but State Farm, Allstate especially, they are protecting the consumers that they have. So when they look at their annual spreadsheets, their book of business, like Joel said earlier, you know, they should see things coming and look and insure responsibly. So from my point of view, they're protecting the policyholders they have and not writing more than they can handle this year. You know, next year they may increase how much they're writing, or they may, you know, start writing new again. But for this year, they realized we need to stop writing new business and protect the insureds we have. And they have a lot of insureds in the state of California. So that's the industry take on it, but I just wanted to throw that in.
And I mean, look at the data and as you will as reporters, you know, with the critical eye, and look at with the critical eye the claims of both sides. I mean, I think as I alluded to in my presentation, I mean, the argument of the insurance industry is, you know, if you look at the 10-year average with regard to the combined ratio, it's 108%, right? Well, that's not a good thing, right? They're paying out 108% on average over those 10 years. But conversely, consumer groups argue and department staff argue, yeah, but financial statements are done on a year-to-year basis, and dividends and proceeds to investors are paid on a year-to-year basis. And so, yeah, there were 2 bad years, 2017, 2018, where the combined ratio was dramatically higher than the premium pulled in. But the other years around that, in fact, the combined ratio was a lot lower, and the companies were profitable. And to the extent that they provided those profits to investors, owners, shareholders, those profits aren't clawed back in order to pay the bad years, right? The bad years are paid for out of the reserves that insurance companies are required to have by the department, which is a part of setting the rates to make sure they have enough money if there are bad years. And in fact, in those 2 bad years, with one exception of a small insurance company that made the stupid decision to basically just insure everybody in Butte County where the campfire was, none of the companies went bust. They had adequate reserves, and the combined ratios since those 2 bad years have been lower. And then the consumer groups also argue, also look at this subrogation issue. I mean, actually, those combined ratios for 2017 and 2018 seemingly do not include the 10 or 11 billion dollars in the PG&E settlement and other returns that the insurance companies have gotten as a result of claims against in utilities, right, that started those fires. So, that's the argument, and you just have to take a look at it and evaluate the claims on both sides.
And remember that all insurance companies don't have investors or are publicly traded. So some are, some aren't. The largest one in the state is not publicly traded. So it's all the insureds that are, a mutual company, any insurance company that's a mutual company, it's all the insureds. So you may be a part of one, but it's not investors. And there haven't been too many dividends from mutual companies. Just something to keep in mind.
Well, and then I guess the other thing to keep in mind too is that it is important to focus on underwriting losses and underwriting profits. But there's a whole other side of the insurance business, which is investing the reserves that the Department of Insurance requires them to hold. And yes, when interest rates were low, those returns weren't so hot. But guess what? Interest rates have been quite high, and potentially on the other side of the balance sheet of the insurance companies, there have been investment returns that are offsetting underwriting returns. So you need to look at that side as well. I think also, the question I pose is too, we can argue about these things, and there are potential policy changes like Florida's enacted and California is contemplating enacting to try to make things better, hopefully. But does all of it get washed out by climate change? And I think that's the Florida example, potentially, right? And so maybe there are things we can do, as we've each talked about, that incorporate more mitigation at the home level, at the landscape level, incorporating that into the rate model, incorporating that in the underwriting model. And that might improve things, allow insurers more rates by using catastrophic models, let them include their reinsurance costs. That might help things, maybe, that's a debate to be had. But does that ultimately get overborne by the underlying risk driver, which is climate change? And the fact that we're throwing more people into harm's way because we don't seem to have lessened our appetite to have more development in the areas that are at the greatest risk, right? And so we're putting more people there, more businesses there. And so, do those phenomenon ultimately overwhelm the policy changes, which might make things better for some time, but then get overwhelmed by these other impulses? So I think those are interesting questions for journalists to pursue.
They are, and definitely an important focus, land use, et cetera. And, as building is taking place, responsible building, incorporating mitigation into all new building, and communities, developers have a part to play in it. The building industry has a part. So insurance is one part of it and an important part, but it's not the whole picture. So I agree wholeheartedly that those are all important things as we move forward if we really want to have resilient communities.
All right, thanks. Ashira has a question.
Yeah, Dave actually just answered it partially. I'm in Florida, and yeah, my question was basically like, Florida's the example that everyone doesn't want to be. And if there are parts of the insurance industry where you feel like you could start from scratch, knowing what we know about climate change, like how you would create
potentially like a better new model that takes that into account instead of like piecemeal tacking on to what exists?
Well, I guess that's a great question, but I mean, insurers are not wizards, right? And so at the end of the day, they're trying to make a profit, and they're trying to provide coverage, but they're not going to make a profit if they write risks that where the risk is really high and the exposure of loss is really high. And so, in certain parts of this country, based on the acuity of the impact of climate change and how it's landing and the kind of peril and the kinds of exposures that are being impacted, it may be uninsurable. I mean, the jury's still out in Florida with regard to wind. They've done a whole bunch of things. They're doing a whole bunch of more things. It may work, it may not work, but so I don't know that. I mean, I guess you could look at one national response, right? So there's a lot of chatter about, well, if you just kind of stop doing the state by state stuff and just aggregate some insurance pool and that spreads the risk to everyone. Well, that's the National Flood Insurance Program, right? So when the home insurance writers about 50 or 60 years ago decided flood risk, we're not so happy about that. We're not going to include that in our homeowners policies anymore because we're losing money on that. Then Congress ran to the rescue and created the National Flood Insurance Program, right? Well, guess what? They didn't require that the rates be set based on risk. So every 10 or 15 years, it's underfunded. So Congress shovels $10 to $15 billion in. Congress also decides, oh my God, we're losing money here, and the taxpayers are having to pay for this. So let's risk adjust. So then they pass a law requiring risk adjustment. Then FEMA goes out and tries to do that. Then people get really angry because their rates are going up, and they descend on Congress. And guess what? Congress backs off and says, oh no, we didn't mean for rates to go up. We're in like the third cycle of that right now. We'll see if it sticks. But even more importantly, what the National Flood Insurance Program does, which is a national flood risk insurance program, is because it's not really risk adjusted in terms of rates, it's encouraging people to rebuild over and over again in areas of flooding, right? Which may not be so smart. Now, just recently, past couple of years, they've started a program where they'll buy people up, but guess what? It takes them 5 years to do that. And it's a very minuscule part of the program. So some of these other solutions that are sort of, pooling risk and nationalizing risk don't necessarily have a good result. I mean, I think, and I think we're better off trying to figure out how to make sure the private sector works, in my view, with a backstop of these FAIR plans where the private sector concludes it just can't write the risk anymore. But in some cases, it just may not be insurable. And that's what I come back to. You remember the James Carville, some of you're all too young, right? But in 92, when Clinton ran, it was the economy, stupid. Well, maybe climate change, I mean, and if we don't address that, and we're not addressing it well enough, then we may do all these things around the edges to make things better marginally, but it may be overborne by what's happening in terms of the climate.
And one thing I want to mention too, at the Insurance Information Institute, we do have a chief economist. So that's a little different because in the insurance world, actuaries are, the ones that put together a lot of these models on how to price risk, etc. But we do have a chief economist, and if you go on III.org, you can read our chief economist's quarterly reports, etc. on, CPI and all the things that are affecting the economy. Just as a journalist, I think those might be interesting to you.
All right. Thank you. There's one more question. I know we're at time. Aaron, bring it home.
Okay, I'll try to be quick. Thank you all. This is really interesting. I was wondering, I think, Dave, you had in your slides as one of the potential solutions, I guess, to this would be to disincentivize or stop putting more people and businesses in harm's way. And I know that's something that we've talked about a lot in California over the years. There's been some legislative attempts at that. So I guess I'm curious how much that idea is coming up in these conversations and things like the sustainability plan. How seriously is that being thought of as a potential solution to some of this, as well as, could the argument be made that the insurance companies pulling out could serve as sort of some of that disincentive? Because I think I've heard that argument made a little bit too. Yeah, that's it.
Yeah, so I mean, insurance pricing and insurance availability is having an impact on real estate markets. But in California, even though there's some empirical evidence that the increased lack of availability of insurance and the higher price of insurance in California for homeowners insurance is having an impact on the duration of closing of escrows and maybe even on price. It's overwhelmed by the impulse associated with the shortage of housing in California, right? We're like about 2.5 million units short. And so insurance pricing and insurance availability is sending a signal, importantly so, which is why we don't want to suppress rates artificially, about risk and whether it makes sense to develop in areas. But think about the development timeline, right? So somebody approaches the city council or a county and says, hey, and look, I'd like you to expand the footprint of your community and allow more development and amend your general plan or your specific plan or pass a different zoning ordinance to allow more development. That gets debated. A lot of those external costs associated with, wildfires, floods, convective storms don't get included in the calculus. Yes, there are EIRs, but it doesn't actually get really quantified in terms of the fees that developers are required to pay. There's this huge impetus for local governments to say more because more is better, more tax, more amenities, more people. So they say more, they permit more. And then the developer comes in and develops, he or she. And then by the time you get to insurance, you're kind of at the end of that continuum. Right now, there is one exception. This is kind of interesting. So the Building Industry Association has testified a couple of times now, both before the insurance commissioner and the state legislature. Hey, look, high density housing, which you all say you want because it's better environmentally and gets people closer to transit and all this sort of stuff. We can't get insurance for it, right? So when we build a condo or an apartment and then we try to go out and get insurance for that, we can't get insurance for that in these high risk wildfire areas. And we can't get the FAIR plan to cover it because there's limitations on the amount of coverage the FAIR plan will do. So we're not building condominiums anymore. Now, maybe that's a good thing in those areas, right? But of course, there's an effort to try to solve that. And so one of the parts of the commissioner's proposal is to raise the coverage limit of the FAIR plan. So it's now $20 million per location to $20 million per unit. And the BIA says, yeah, that might actually help and we can do more condo development. Maybe that's good because it's higher density development. Maybe it's not a terrific idea to be developing in these areas, right? So there have been bills proposed that would place limitations on development in high risk areas. There have been bills proposed that would incorporate the social costs and economic costs of that development into those decisions. Those bills die. Why? In the face of opposition from the building industry, from the real estate industry. And also you've got this counter impulse, which is, oh my God, we're 2 million units short. We got to build more. And we can't be particular about where we build it, right? Which is maybe where the governor is right now, So, I think you would think that there would be more effort on the land use side to try to constrain the footprint of development in these areas. But I think politically, it's really challenging. And to expect the insurance pricing and availability issue to solve that problem, I think is putting too much load on the insurers, unfortunately. So then what do? We do building codes, we do defensible space, we do mitigation, we try to make the buildings that are there and the new buildings that sadly are going to go there, better and more likely to withstand wildfire risk. And we hope to God we can get the insurers, in some cases are already doing it, in other cases not so much, to reflect that in their underwriting and their rating. And that may make things better for a bit. We don't know, but it also may ultimately be overborne by the underlying risk of climate change.
And we did see a few lawsuits from Rob Bonta, the Attorney General, for about 5 developments across the state. So that was kind of one of the first things I've seen that was significant in saying no on the land use side. But it was no, you have to do this in order to do it. So like the one that's near me, it was you have to have better evacuation routes, which would be great because that's so important. But we'll see how that goes too. And that's kind of a small dent in the whole thing. 5 developments in the state like California.
Yeah, and if we get a final word, I would just like to say that overall insurance is a beautiful thing. I know most of us see it as something you get the bill and you resentfully pay it year after year. And if you're lucky in life, that's all you'll ever do with your insurance is begrudgingly send off the money and never ever use it. But I will say, if you ever are in a situation where you see loss around you, and you're dealing with people who have to rebuild or replace things they had, or if you ever accidentally rear end somebody in an auto accident or something, the first thing you're going to think of is your insurance coverage, and be grateful for what you have. And so even with all of its problems and its costs, when you see it at work after a catastrophe and people coming in to a meeting and working through that claim, even though that can be challenging, that you have it is super valuable. And I hope, as journalists, you always got to emphasize the value and importance of having it. We mentioned the renters previously walking into these centers, and they walk out with maybe $100 credit card from the Catholic Charities, and that's all they get, right? That's all there is for them. So I'm grateful for what insurance does and for the product it is. We just have to continue the struggle through the challenges that are part of the business.
Thank you, Joel, and thank you, Janet, and thank you,
Thank
Dave.
you.
Appreciate you guys sticking around for a few extra minutes to take all these questions. And now you get the patented IJNR golf clap from those who are remaining. For the journalists, well done today. It's been a long one. We will see you all tomorrow at the same time, and we'll talk about some